Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it together, generally related to three different topics: wealth building, commodities, and/or financial topics. Let's dive right in and take a look, see what's going on today. If you want to follow me, it's @Finance. And if you want to join our community, finding-value.com is where you want to check it out. I dive deeper into a whole bunch of different things and share that share everything with the community. Uh, you can see the special code in the corner there. Scrolling down, starting with Calvin, he says, if you were hedging your investments for a world where machines run everything, including discretionary fund allocation, what do you think the machines would value most? In my opinion, it's energy and raw materials, especially metals. I actually agree with that. I've put some, maybe not a ton of thought, but I put some thought into it about artificial intelligence and what exactly it's going to replace. All I can think of is that it's going to help with the efficiency of converting energy and materials into final products. So all of the wealth in the world would essentially be stored in raw materials and energy. Because if you bring all of the barriers to entry to nothing, so there's no barrier to entry in terms of design work, figuring out the configuration of these materials, if that all gets essentially flattened to how fast AI can compute, well, then all materials is what the wealth is, because AI is going to figure out how to configure energy and materials to make products that people want. And that's ultimately where all of the wealth would be. Right now, a lot of the wealth is stored in businesses that convert energy and raw materials. But artificial intelligence would essentially destroy all of those businesses because the competition would essentially flatten all that to some degree, I would think. And all the materials and energy would be the feedstock for artificial intelligence. This is out in the future, not immediate. Out in the future would essentially be the value. I don't even know if currency would have value in the future. Um, Actual paper currency or even central bank digital currency, because I mean, if you could, you'd use artificial intelligence to make machines and or things out of materials and energy, and it could figure out how to do that. I don't know if it could substitute the materials or the energy itself and find something else. Everything comes from the sun. Humans have not been able to generate electricity or power from nothing. So we've only been able to gather energy from our surroundings. But I guess if it could figure out how to create a star or fusion, maybe it could figure out how to do that. I don't know. Ian Castle says, to achieve multi-bagger in a portfolio, you have to hold a multi-bagger in the portfolio. You will have to hold it while the stock does a 2, 3, 4x in a year or longer. You will have to hold as the stock eventually pulls back 50% from its highs. You will have to hold as the stock goes nowhere for months, quarters, and maybe years as fundamentals backfill into the stock price. You will have to hold as expectations get too high or management has some eventual growing pains. You will have to hold when it's cheap, expensive, loved, hated, and volatile, sometimes all in the same year. You will have to hold while your emotions are screaming at you to sell. What makes it even more difficult is very few will deserve to be held through all of this. Most of the companies you own today only deserve to be rented. Ownership is earned. I've gone through this already. I've gone through many X in a few years. I've held through 50% pullbacks multiple times in the same stock. I've done nothing in it and I'm still waiting for the market conditions to swing back around in favor of these companies that I hold. I held in what I believe is a super cycle, wave one, and I held through wave two, and I'm waiting for wave three for this big move to move into the wave three of Elliott wave. So yeah, that's all required if you're going to hold through the entire bull market. People are going to tell you, why didn't you sell? Why didn't you rotate into this? Oh, it's so hard. I don't know, guys. I mean, you don't pay tax. If it pays a dividend, that's great. You get to hold it. Could you trade your way into it? Not many people trade to success, and you'll screw up the timing of it. So I think getting in early and holding on through the entire bull market is the way to do it. You don't know what that pattern will necessarily look like. It's very difficult as you go through it real time to time things perfectly. And the less decisions you make, the less you get to screw up. So my decision is to hold, accumulate on pullbacks during a bull market, and just let it ride. I think he's exactly right, though. Exter's pyramid shows the global asset stack, 742 trillion in derivatives, 380 trillion in real estate. And at the tip, gold. It's just 18.2 trillion. Unlike everything above it, gold has zero counterparty risk. After Liberation Day, even US Treasuries sold off while gold surged. This is the pyramid. Everything on top of it, derivatives, real estate, debt, money supply, the stock market, is all upward, while the tip of the tip is gold. They have Bitcoin in here. I'm not so sure that I would put that there. You do what you do. You, if you think you should put it there, that's fine. But gold, silver, platinum, some other materials, I would say, is in the tip of Exeter's pyramid with no counterparty risk. Warren Buffett said, I went the whole gamut. I collected charts and I read all the technical stuff. I listened to the tips and then I picked up Graham's The Intelligent Investor. That was like seeing the light. So he's been in the markets for a very long time. There's a reason that Warren Buffett does not use technical analysis. Now, some people would say, oh, well, he's just not good enough. It's just not this. Guys, he is one of the most successful investors. He's compounded one of the longest periods at a very good rate. And at the end of this, I mean, he's basically the market himself, practically. He's a big portion of the market, and he was very limited to the stocks that he could invest in. But what makes you think that you picking up technical analysis and doing all that, what makes you think that you're better than him? What makes you think that you have figured out something that he hasn't? He lived this game, he loved this game, and I'm sure that he looked into it very well. I'm sure he used some technical analysis, but I also think that he leaned very heavily on the valuations. I'm taking a very similar approach to him. I think it works quite well. And the way that I looked at it is I said, what is something that is universal across the board that you could use that always keeps you in cycle? Now, some people are going to try to figure out the cycle. Some people are going to try to look at, ratios, which I think is a good thing to do. Valuation is the only thing that keeps you on the right side of the cycle, no matter what. It keeps you from making dumb mistakes and buying overvalued stuff that you're trying to chase price performance. It keeps you on the right track in the undervalued sectors. Now, undervalued sectors are the ones that are out of cycle. They keep you they keep you at the bottom of cycles and away from the top of cycles. So if you were to continually look for value the entire time, you would skip on all the bubbles because you wouldn't chase the bubbles if you implemented what he's doing. And then it would keep you at the bottom of the cycle. So valuation is ultimately the best way to time something. Now, some people will say, well, you could buy it and it could stay cheap for years. That's very true. But tell me another way that's better than valuation than trying to only use, say, technicals. I think the best approach is to use everything. Use fundamentals, use valuation, use technicals, try to do it all. It just takes it's a tough thing to learn with any sort of speed though. Here's Grady. He says, posted this chart in the linked post below at the backtest at $280, saying it was the next big buy and add point. It was. As said for years now, I'm convinced this chart will play out. It is happening. And that's the gold miners, Huey, breaking out of its downward trend line to the upside. And he sees a 1,250% increase from the bottom of 23 to where somewhere in early 2030s, it looks like. Very big move, very similar to the 2000 to 2008 move. He says we bought the very lows, different company categories at the two different lows in here. And it says, is it time to revisit the upper trend line of the channel? He says, I think it is. Coming down to Katusa Research, if you listen closely, the copper price is telling you something. Near record close for Dr. Copper, what's it diagnosing? Weaker dollar, stronger economy, maybe a little bit of both. Stronger economy and weaker dollar is what I see. Here's Brandon. He says, don't listen to the gurus. Learn from the best traders to ever live. This paragraph is from Michael Marcus, is as good as it gets. So what is the answer? He says, I think the secret is cutting down the number of trades you make. The best trades are the ones in which you have all three things going for you. I call that confluence. Fundamentals, technicals, and market tone. First, the fundamentals should suggest that there's an imbalance of supply and demand, which could result in a major move. Second, the chart must show that the market is moving in the direction that the fundamentals suggest. And third, when news comes out, the market should act in a way that reflects the right psychological tone. For example, a bull market should shrug off bearish news and respond vigorously to bullish news. If you can restrict your activity to only those types of trades, you have to make money in any market under any circumstance. That's what I call confluence. The three pillars is very similar to what he is trying to say here. He's using market tone, which is basically if something bullish comes out, we should rock it. If something bearish comes out in that same sector and it holds steady, you're in a bull market. Technicals, well, that's the technical charts and stuff like that, which we use. Fundamentals, what I use for fundamentals is I use ratios, which shows me what's undervalued, and then I use market cycles. So the market cycles in the ratios tell me about the fundamentals and valuation, and it also tells me about what to expect for market tone, in his words. The technicals are just patterns and charts that we're looking for big bottoms, and then we're turning up. When you turn up, that suggests that the market tone has changed. A paradigm has occurred. The fundamentals, I look at fundamentals as valuation. Valuation is what you pay for something. And the fundamentals are a way to ensure that you're paying less than what something is worth, at least the way that I view it. Logan says, you don't want a recession now. Rates would go lower, demand would pick up, and inventory isn't back to normal yet for existing home sales. So we still have a very low inventory and the seasonally adjusted annual rate there. If we get a recession or a slowdown in the market, rates will go down and house prices will go back up, is his opinion. Affordability is rough, but affordability would get better if rates come back down. So we need to get inventory levels up before we have that occur. This is interesting. Saudi Arabia oil rig count for Baker Hughes is down. It's been crashing. What's going on here? Are they pulling back on production? Have they kind of given up? I don't know. I've seen a lot of the rig count come down across the board around the world. So yeah, rig count is low, and I think we're probably going to be entering, I think, the bottom of the cycle for drilling in 2025. That'd be my guess. The metals and mining ETF is printing fresh multi-decade highs. The top five holdings here, we've got Cleveland Cliffs, Warrior Met Coal, Core Natural Resources, Nucor, and Alcoa for metals and mining ETF XME, which is the highest close since 2011. Looking pretty bullish. Base metals are breaking out. This is the ASC Base Metals Index, equal weight basket of copper, aluminum, steel, nickel, tin, zinc, lead, and iron ore. That's all looking pretty good for base metals index. I talked about this one last time, so we're going to end it there. But that's what I've got. Guys, so give me a thumb up for the content, subscribe to the channel, subscribe to the website if you like. And that's all I've got for today. So we'll catch you next time. This is Finding Value.